Welcome to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Vitaliy Katsenelson, Chief Investment Officer of Investment Management Associates in Denver, Colorado. Vitaliy is the author of The Little Book of Sideways Markets. He's also taught classes on investing at the University of Colorado's Graduate School of Business. Let's ask him 5 good questions. Welcome back, everybody. My guest today is Vitaliy Katsenelson, author of The Little Book of Sideways Markets. Vitaliy, where are we talking to you today?
I'm in Denver in my office.
Nice. This is world headquarters, huh?
That's right.
So, Vitaliy, let's jump right into our 5 good questions for you.
All right.
Question number 1, and this has to do with your book is all about this idea of sideways markets, and I think you first started talking about it in 2007. Is that right?
I started to write. Sat down to write my first book in 2005, and it came out in 2007. Yes.
Okay. And back then, your prediction, and it was based on a lot of historical evidence and where we were at that time, was that we were going to be in sideways markets until roughly 2020. And then now it's roughly 7 years later. Do you still like that 2020 kind of forecast, or has anything changed in your mind since then?
Today it looks like about right. Let me explain how I get there, because
Yeah.
nobody really knows, how long it's going to last. But let me tell you where I'm coming from, and then it's going to make sense how I got to 2020. So let's talk about sideways markets and why they happen. So if you look over the last 100 years, every time we had a secular, which is a long-lasting bull market that lasted 15, 18 years, the market that followed was not a bear market, not a declining market, but a oscillating sideways market. Sideways market that's basically going nowhere for a long time. Just think about this for a second. So for 15, 18 years in the past, market has gone nowhere. It doesn't mean it stayed flat. You had a lot of volatility inside of it. If you think about the last sideways market we had was from 1966 to 1982. And during that time, I think we had 5 little bull markets and 5 little bear markets. So today, we're basically we're going through one of those bull markets, hopefully. And at some point, it's going to turn into bear market. I have no idea when. But here's the key. Why you have bull markets and sideways markets? It's very simple. The most important formula you need to know about stock markets or stocks that explains why stocks go up and down is just this formula. It's a change in price. Change in price equals change in earnings and change in price to earnings. So over the last 100 years, earnings grew about 5 or 6% a year. And that growth was actually constant, more or less, throughout sideways markets and bull markets. So that was not the variable that mattered. The variable that mattered really it's the price to earnings. In the bull markets, price to earnings started very low, and it went like a pendulum. It went very high. So in 2000, I think price to earnings was over 30. And I'm talking about 12 months trailing earnings. Since then, what happens in the sideways markets, price to earnings starts from a very high level, and just the reverse of it, it starts going down. So the earnings growth is really the factor that takes the PE, price to earnings, from high to low level. So today we are, 14 years into it. If you look at the valuations today, they are one of the highest we ever had. So, so that's point number 1. So this is why I think we still have a sideways markets ahead of us. Is it going to be 2020? I think unfortunately, that's probably the shortest it's going to last now. Okay, so the valuations, very, very high. In fact, usually sideways markets started at these valuations. That's point number 1. Point number 2, if you look at today, our government is a lot more leveraged than it was before, and the interest rates at a very low level. So as government deleverages, that's destimulating for the economy. So that slows down the economy. So therefore, earnings growth is going to be slower. Also, at some point, interest rates will rise. Okay.
Right.
Today,
that's a good segue into question number 2 that we had, was that the current state that we're in is record high profit margins, very high valuations, and rock bottom interest rates. And if you look back at 1982, basically we had the exact opposite of that. A mortgage was 15%, so interest rates were very high. Earnings were down at more like 2% instead of long-term 6%. And then valuations, PE I think was down at 8 in 1982.
Right.
So we're like 180 degrees out from where we started in 1982 of this, very epic bull run. Does that how much are you basically saying you don't expect much returns for us from here based on all of those things?
Yeah, I think so. And on top of what you just said, you had a high, very high profit margins, right? And the profit margins right now are the all-time high. So stocks, if you look on the forward 12 months earnings, etc., stocks don't look that expensive, except once you start normalizing margins, which means in this case basically lowering them down, suddenly stocks become extremely expensive.
Right.
What we saw in the past was this: the GDP growth was very, very consistent. In fact, you can say that real GDP growth was at 3%, was probably one of the most consistent figure going backwards. Okay, and earnings in the long run they grew, but the growth was not even. So you had a very high growth above GDP, and then it would be below GDP. And the only reason you had this growth like this because profit margins would expand, and then they would contract. And this time around, it's the highest expansion we ever had, and probably one of the longest expansions too. So at some point, profit margins decline because, as Jeremy Grantham put it, capitalism works. Okay.
Yeah.
At some point, profit margins, the excess profits will get competed away, and the profit margins will decline, and earnings growth will stall. So also interest rates, and maybe interest rate will add to that. As interest rates rise, they'll start impacting government, and also going to start impacting corporate costs as well. So the question I get asked a lot: are we still in the sideways markets? In a sense, because people look at what happened from 2008 to today, and they say, well, it seems like we had a great bull market. And I say, yes, we were in a cyclical bull market, and the sideways market has a lot of bull and bear markets.
Yeah.
So we just, we are in the phase of we're still in the sideways markets, but we're in the cyclical phase of a bull market.
Yeah, but the clock hasn't stopped yet. So
no, it hasn't. For the next bull market to start, it's almost like you need to add this fuel to a rocket. You need very low valuations. That's what usually starts kind of sustaining long-term bull markets. Today, valuations are extremely high, so it's very unlikely that. I mean, the market can still go another 20, 30% or even higher, but it's not going to be a sustained run. At some point, the pendulum of price to earnings will swing back.
Yeah. Let's shift gears now for question number 3 from kind of the more macro to a little bit more micro. In your book, you have this example of this farmer named, I'm not sure how do you say his name. It's
Tevi.
What is it?
Tevi,
yeah. And Tevi is he's deciding whether to buy a cow or not, and he's looking at all his risk versus reward. And I thought it was a really great example of bringing this nebulous term of investing or value investing even into a simple kind of allegory. Could you walk us through that, please, and just share some of the insights of that?
Sure. So let me tell you a story that's never been told before, how the story came about. I think at the time I used to teach investment class at University of Colorado, and a day before I explained discounted cash flows using a cow as an example.
Yeah.
How much would you pay for a cow? If cow gave you that much milk, it would if you sold the cow at the end of year 5, and we just kind of went through this example. So the next day I was working my book, and I had a writer's block. So I went on YouTube, and I was playing different music videos, and I think I got to Barbara Streisand, and somehow I got into the video of Fiddler on the Roof from Barbara Streisand, and the class from yesterday connected with Fiddler on the Roof, and I said, how about I'm gonna write about a Tevi from the Fiddler on the Roof going to buy a cow. That's how the story came about. So the reason I think the story is important is that as an investor in the stock market, it's so easy to start looking at stocks as stickers and start treating them as basically as trading vehicles. And that example of a farmer going to buy a cow and kind of walking you through the logic of how would a person, a businessman would analyze an investment, basically starts putting you in the shoes of an investor, like an investor that looks at not the tickers, but businesses. And the stock market, every time you come to work, the short-term volatility tries to drag you away from that, and and make a trader out of you. And I reread this story myself, once a year at least, just to get back into this, investor mood.
Right.
It kind of puts you back in, into the shoes of an investor. So I think that story, is important just from that perspective.
Yeah. No, it's great. I think that's a good idea to center yourself more on a Benjamin Graham style of, business like investment, and not so much trader chasing news. And all right, let's do question number 4 now. And in your book, you obviously talk about the importance of capital allocation, including stock buybacks, and how those can be both good and bad for shareholders. Me personally, looking at the track record of the typical S&P 500 company and their buyback timing, I have to say that I don't think that they've been doing a great job. There's record high buybacks in 2007 at very high prices. At 2014 have been very high prices. 2009, when stocks were extremely cheap, there was almost no buybacks. Aren't these supposed to be the best and brightest that we have running our 500 biggest companies in the world? What's going on there? How come there doesn't seem like they've been doing a very good job?
Well, first of all, I think you answered the first part of the question already, because they are not. You're right. Absolutely. If you look at the track record, the corporate management had a fairly horrific track record of buying back stock. So I think there are a couple issues there. Number one, management starts believing themselves too much. I think management is not very good at valuing their own business, even though they have more information about the business than we do. As the outsiders, at the same time, I think they are less objective about the business because it's their baby.
Yeah.
Okay. So they usually overpay for. They're usually too optimistic, and they usually overpay for the business for their stock. That's point number one. Point number two, you also have a lot of biases that come from incentives. Their investment package, their usually compensation is tied to stock price, etc. So they will be buying a fairly valued or overvalued stock just to meet, just to drive the stock price higher, which is not necessarily. It may be in the best interest of, in their best interest, but not in the best interest of shareholders in the long run. Also, and this has to do not with stock buybacks, with acquisitions. A lot of times I find that a lot of value is destroyed by management is not through making bad decisions running the business, but on capital misallocation. Not just through stock buybacks, but through acquisitions. I mean, take Hewlett Packard. I mean, it used to be this incredibly innovative company, and then over the last 10 years, before Meg Whitman came aboard, they basically replaced their kind of R&D impotence with acquisitions, which destroyed an incredible amount of value. So I think acquisitions probably hurt companies a lot more, I would argue, than stock buybacks. But at the same time, we find that if we find a company that's undervalued and management, is committed to buying back stock, you can create a lot of value this way. And I'm sure you can refer to Henry Singleton from Teradyne, who created an incredible amount of value for shareholders. But those are what you basically find. Management will tell you all the right things you want to hear. They'll tell you about, when you ask them what they're going to do with your cash flows, they're going to say we're going to maximize shareholder value, etc. But at the end of the day, you really want to look at the actions and not what they say. And you want to assume that they probably, unless they have a very good track record of capital allocation, and this is a key for us now. This is why I want to have a very large insider ownership. If they own 20-30% of the company, like Larry Ellison of Oracle, I know that when he makes an acquisition, it's going to be the right acquisition because he's spending his money not somebody else's money. So I think that very large insider ownership cures a lot of problems.
Yeah, kind of the difference between a manager and an owner.
Absolutely right. Exactly.
Yeah. All right, let's jump to question number 5, and this has to do with the importance of absolute cheapness versus relative cheapness.
Sure.
I think you could make the argument that you could find some things that are relatively cheap today, but it'd be hard to say that they'd be absolutely cheap on a more normal basis in a more typical market, especially given that the dispersion of stocks is so tight right now around that very expensive mean. So if you think about like a bell curve,
Mm-hmm.
like a very wide, the cheapest versus the most expensive, as opposed to it's very tight around it right now where the cheapest and the most expensive are kind of close together. It means it's hard to find anything that is absolutely cheap. Do you think that a lot of investors are missing that concept when they're talking about the relative cheapness of stocks today?
So when the investors talk about it, they especially in today's environment, they comparing this to the interest rates and look and say, well, look at this company. It has a yield of 2% or 3%, and a 10-year bond is at 2% or 2.5%. So this is the first time they mention this. The second time when they say, look at this company, it only trades at 20 times earnings, and competitors are trading at 25 or 30.
Yeah.
Okay. So I think in sideways markets, especially, you want to be an absolute investor, absolute valuation investor, not relative. And here's why. The relative is important, but it should always be subjugated to absolute valuations. So here's what happens. In 2001, Walmart looked cheap because the time was trading at 20 times earnings, and 2 years before, 5 or 3 years before, it was trading at 30 times earnings, right? So you could have argued Walmart is cheap relative to its past valuation, and since then the stock has gone nowhere, maybe just went up recently, slightly recently, okay? And the reason for that, because the valuation of the past bull markets, they may reappear for a while, but they'll go away, okay? So that's point number one. Point number two, you also want to be careful because interest rates, if something looks cheap relative to today's interest rates, if interest rates change, interest rates will not stay at this level forever. I don't know when they're going to go up, but at some point they will likely to go up, and suddenly this stock that looks cheap just because it has a yield a little bit higher than 10-year bond, suddenly it will not look cheap anymore. So what we try to do when we do our analysis, one of my favorite tools, but it's a tool I use with other tools in conjunction, is discounted cash flow analysis. Okay, discounted cash flow analysis, when you use discount rate, we start with 10% and higher, despite Treasury bond being at 2.5%.
Right.
So that makes our analysis absolute.
Right.
So
what is pretty strict amount.
Yes, exactly. And if the company is riskier, etc., we'll take it higher. But that's how it forces you into absolute valuation camp. And I think it's important because this way you don't get into absolute relative valuation trap, where something looks cheap. And by the way, if a lot of mutual fund managers are kind of forced into this game, but they're going to buy company that they know overvalued, but is less overvalued than its peers. And my argument is, if you're looking for stocks to buy and you can't find something that's absolutely cheap, just have more cash.
Yeah, I agree, and I think the way that we look at it is that the longer term look through value of that cash is actually quite high if you imagine that at some point you're going to have very attractive opportunities.
You're exactly right.
So those are our 5 questions. Now we're ready for our bonus question now, and this is to get your book recommendation. And this is a book that either you found is either underrepresented or that you found is just the most helpful book and that you've given away a lot. What do you have for us?
Okay, I'm gonna follow Howard Marks. Okay, okay. So I'm gonna try to supersize him a little bit. So he recommended Fooled by Randomness.
Right.
that until about a year and a half ago was was my most favorite book. And then about 2 years ago, Nassim Taleb, who wrote the Fooled by Randomness, came out with the Anti-Fragility.
Uh-huh.
And he took a lot of the concepts that he discussed in Fooled by Randomness, and he, expanded them. And I think that book probably, if you judge by how much I basically judge how good the book is by how much I highlight. It probably has the most highlights per square foot or per square inch ever. I mean, every page has 2 or 3 highlights. What's great about Anti-Fragility, it's a book that gives you a new framework to look at the world, not just to look at the economy, but also look at stock, and also even will help you to raise kids a little bit. And I highly recommend it. And at some point I'm going to do a review of the book because I think it's just a phenomenal book.
Yeah, I agree. I think as far as adding another tool to the toolbox, it was just even the idea that the spectrum, it does not go from fragile to robust. There's actually a whole nother half of the spectrum of things that benefit from volatility. I mean,
and look from stock selection perspective, right? Companies that are under-levered, the modern portfolio theory says that they are not, they should utilize more debt.
Right.
Because their capital structure is not efficient. And he would argue that, these companies are actually, companies that are under-levered, they actually have a lot of cash. If you think about, they would benefit from fragility, right? Because if there is a risk, if there is new risk, and if you're a Russian company today, and you have a lot of cash on the balance sheet and you have no debt, US-denominated debt, you can probably take advantage of what's going on in Russia today and buy a lot of your competitors on the cheap. So you basically just benefited from risk. So you became anti-fragile, because the risk actually helped you.
Right.
So in our portfolios, in our stock selection, we try to look for for anti-fragile companies. They're probably not going to be they're probably going to have an inefficient debt structure, inefficient capital structure, because they're going to have too much cash, but that's okay.
Yeah. Right. Well, Vitaliy, we really appreciate your time, and thanks for coming on.
It's my pleasure. You're doing a great service for everyone. Thank you.
Thank you, sir.